I'm Ashton Addison from Blockwest Capital for Investment Pitch Media, and today on the Crypto Coin Show, we have Jag Sidhu back with us, the core developer of Syscoin. Jag, welcome back to the show. It is always great to see you.
Always glad to be here, Ashton. Thanks for having me.
Likewise, I know that you're always head down building the future of the blockchain industry. There's a lot to talk about. I know Syscoin has developed a lot in the last year or so in the latest advancements with ZK, rollups, DAOs, other blockchain architecture that I want to dive into. I can link the previous interviews that we've done down below. We did talk a little bit about Dysis. I want to get an update on that today, but maybe we can just start from a high level and just a few of those touch points on, what has the Syscoin protocol been focused on, and what have you been really working on throughout 2023 so far? And then we'll dive into a few of those different topics.
Yeah, so since we spoke last time, we've released our layer 2, which is Rolux. And really all of the validation since we began, where we started with a monolithic infrastructure based on Bitcoin, and then did merge mining and all this stuff where we thought we would need, smart contracts didn't scale at the time. So we did some hard-coded smart contracts with assets and these sort of things. You remember that evolved into an EVM, and then we discovered the data availability problem. We created a solution for that, unique to what proto-dank sharding is doing on Ethereum. We've validated this whole push the whole way. We've been leading kind of the design, and we're a little bit more flexible in Ethereum because they got such a big community and more developers to go through the gate process to make changes. So we're able to be nimble enough to have these things implemented really quickly. And the validation of a modular blockchain infrastructure is going all the way back to Web 2, where you have to break things up into pieces to have separation of concerns, and users are going to funnel through this area, so you have to scale that up differently than other areas, and consensus is critical. Think of that as a court system. We've spoken of that many times before. We validated that whole concept, and we've released the infrastructure now, and it's working well. There's been no downtime, so it's really been pretty successful on launch. And we're getting into like a sort of a DeFi launch phase now, and this month, next month, heading into Dev Connect next month. So it's really exciting that, the infrastructure is built out on Sys and validated. It's using Bitcoin security. It's using data availability. So it'll scale as much or better than any of the other rollups or even entire blockchains with full security in mind, with the merge mining of Bitcoin on top of that. So really hats off to the dev team and the vision behind Sys to grow the way it's supposed to. We think blockchain should be growing. And we really do think it's the ideal design. We'll stand up against anyone on that. Like, we think it's the design that leads us into, what we're saying is this armed race headed towards AGI, right? Like, in order for us to actually create a better philosophical structure of economics in our society, we need to remove the monetary incentives for governments to corrupt and to hold, we should be holding them accountable. So having something like this where you have Turing complete design, it can scale, it's secure, and there's no head of the snake to cut off is really important for us to be able to get to the next iteration of how we are going to evolve as a society. We think it's the ideal way to get there. It may not be ideal once something like AI really takes hold and starts to recreate software. It's a way for humans to reach their peak, and before we start to use AI as a tool to recreate code and do things, and maybe at the quantum level a little bit differently than what we're doing now.
Definitely. And I love that you always mention, the security of Bitcoin. No blockchain is more secure, at least in the 14 years that it's been running with zero downtime as Bitcoin. So to back onto that, obviously, it's going to have huge advantages. You mentioned about that you now have rollups on layer 2, data availability on layer 1, and that Syscoin and blockchain hopefully is ready for mainstream adoption. I guess with all the architecture and the backend stuff, sort of up to par, how does that translate into actually more adoption from non-tech users and people outside of Web3 to now enter into the space?
So if you go really, really high up and say, what if you're starting blockchain in 2009, 2008, what would you build on top that would make sense for a utopian society, right? And given the fact that there's an arm race in AGI, with AI, with social media and influencers, how they're controlling narratives online, and with securities and the clash between the financial conglomerates of the Web2 world versus the Web3 nerds, how you can get together to create tokenized on-chain securities. That's a, $10 trillion market coming up in the next few years, right? So all of those things are the ideal use cases you'd focus on. So those are the high level pictures of what we want to work on to start. The real world assets, there are the social aspects of what we're calling SocialFi, but not only that's a super app concept. It's where X is going. It's where WeChat, Alipay, everything is going that direction. Social super apps, they have to be built from the ground up with AI in mind, specifically with LLMs. So you need to have an AI-driven social super app that brings in the SocialFi aspects for human-to-human incentives and interaction. It's really the interface of how you would talk to an AI. I can't see of any other better way outside of maybe AR, VR, directly pinged into the digital interface, or maybe neural implants in your brain that's actually talking online to interface with AI. The super app is probably the last place you'd look for an application interface where humans would ideally find the best place to use tools with AI. So social and aspects of human to human interaction, human to AI, AI to AI, is what, like, almost a decentralized operating system that you're creating. So that is another sort of vertical. And then itself, the economics of trading, the economics of holding assets, of ETFs, of managing stores of value, of creating a monetary mass of currency. That is the last thing that we're focusing on. That's the DeFi sort of push towards. It's a combination of NFTs, DeFi, and sort of on-chain economies that come to life. And we have a unique take there that we think supersets everything that's been done in the Ethereum world today. So those 3 or 4 angles are kind of, if you step back far enough, you abstract the concepts, those are the building blocks for, what we're going to say is in the next bull run, what is going to be important to investors, to mom and pops, to institutions, and even to technologists looking to take advantage of this technology exponential boom we're going to be in the next 3 to 5 years with AI.
Mm-hmm. Great points. I feel like the tokenization of the stock market and just bringing the S&P and the NASDAQ into the blockchain is sort of one of the early thoughts you'd think. When we want to get Bitcoin is already digital money, how can we turn the financial industry into more of bring the advantages of blockchain into that? But then also what you're mentioning about SocialFi, bringing blockchain to the mainstream through social media, connecting human to human interaction. That market is, almost everybody is using social or messenger at some point here. And there's been advancements in both. I feel like there's more barriers to entry on the financial side, as in trying to find the right architecture to make sure that the stocks don't mess up in the blockchain, but also on the social side, having the right entrance of the user interface, user experience, so that people like the older generations can also use it as easy as they would use Facebook Messenger, and they don't really know. Out of those two, do you see one of them sort of coming first, or they sort of both grow at the same time, and which they're both important, but in what aspects?
Would maybe mix and match with each other. You have what we're calling Kamada is sort of like the securitization of assets on chain, but we come from an anarchist Bitcoin side point of view where we think these assets should be as decentralized as possible. So we've isolated the pain points in analyzing these security tokens, not to have total governance over ownership through an issuer, that you'd have in like the T-Rex protocol, which is what many people are using today, but more gives the sovereignty of the ownership of the asset, but in a way the pain points are the issuance and the secondary trading. When you have stuff like on-chain digital identity and on-chain attestations, or even ZK-based attestations, either soul-bound tokens or however we're doing it. In our case on Rollux, we have Ethereum attestation service built into it. So this unique solution that we can tie in on-chain digital identity attestations for KYC checks. You need that for security tokens where you're doing issuance. So if you're issuing some private company and you're issuing debt on that and you're tokenizing a company that is under $1 billion, you can't go on NASDAQ or anything like that. The only option is to go into private brokers, and then you have a private pool of money, and hopefully they're big enough to get you some sale. But there's no public way because of different regulations and sandboxes across the globe. You need to solve for that in an abstract way to make that go public. And the two problems there are primary issuance and secondary trading, because those need to be sort of regulated. If you have a real estate building, it's always going to be centralized. You can't decentralize a building. And so you always have someone owning the building or managing the building, distributing profits on the building, which some of that could be democratized or decentralized in ways you're distributing profits on the chain. But there's the ownership of the thing is always going to be sort of centralized. And so that's where issuers come into play. The issuers are the people that bring this whole thing to life underneath. They're regulated, they're understood by the governments and the tax authorities, and who's owning what, who's making money, who's losing money, until maybe in 5 to 10 years where maybe everything just moves on chain and it's IoT focused. You do have these issuers there. But in order for us to kind of decentralize as much as possible, the two pain points, we just put the KYC checks there. So if you have issuance, you have a sort of like a crowd fund with KYC where you're doing an IDO and people have to register with the service. You're allowed to technically, and we've covered this with our security lawyers, basically in a generic way, you should be able to always exit out of that, but you have to wait a certain amount of time. So when the legend is removed from, we typically would only deal with assets that have legends and prospectus. So they're not, I have a mine and I want to take gold out of it, and, it's very early phase. We would deal with more, you get a legend and prospectus, which is a well understood document that your government knows what you're doing and how you're going to raise funds, and you have an asset behind it. So you have that, you can come, and it's pretty easy to get that. You have that, you come, you do a crowd fund. You'd have to have registered investors come into that, depending on the type of sale. It could be registered, or it could be just someone that just registers their KYC. It doesn't need to be a registered investor. Now you do that sale once the legend is removed, which is codified in the smart contract. Again, we would check, okay, is it 6 month or 1 year, whatever. You're allowed to exit, but we can't stop you. What we're checking is, are you allowed to participate? And when you exit, you're exiting in ERC 20. So you own that asset and no one can take that away from you. Not a whitelist or a blacklist. It's literally decentralized. Now you can do whatever you want in there. Just like if you own Bitcoin, you make some trades, you have to tell the tax authority that you made some trades, you made some profits or losses. In the same way, we're following the same sandbox rules to say that if you do want to trade, you have secondary options to trade. So in our DEX, we call Pegasus, which is the native DEX to our blockchain, we're making a slight tweak in that. And we're opening up a huge use case for security assets. We, on the last route of a check, when you're in the DEX, you have multiple routes. Technically, when you go from, say, ETH and you want to buy, I don't know, Matic, you'd go from ETH to USD and then Matic, and you jump through routes to find, for capital efficiency, it would just go through the different DEX pairings. And on the last route, if you're touching a compliant asset, that's where we would again invoke the KYC service to make sure that that person should be allowed to hold that. But it doesn't stop you from playing with your asset to touch all other forms of liquidity. And the key intuition there is to understand that in the counterparty check, the smart contract is the counterparty of your asset. And so even if you are dealing with security tokens, if the route is touching decentralized tokens that don't need these KYC endpoints, the smart contract is the counterparty to your trade there. So you can forego any checks because smart contract is not a person. Where the check is needed is where the counterparty is a person taking that end of the trade, which is the compliant asset. So this means you can use all sorts of liquidity, all decentralized, centralized forms, and a shared liquidity pool, which allows it to get much faster to go global because you have a shared pool of money that can interoperate and feed back into not only private assets, but public assets in a feedback loop. And you're taking ownership of that, you're trading it. That's the endpoint that would need to be checked.
Very interesting.
In intermediate phases, you don't need any checks.
So with PegasysDEX, I feel like that's been a major barrier to the adoption of security tokens, is not just the issuance, which is a whole, process in itself, but the trading of it, having a security tokens only exchange and just like low liquidity there. And it's like, okay, sure, now we're being innovative and our company's tokenizing our stock, but like we're the only one on the exchange and there's nobody else there. And it's like, so we have to wait for the whole industry to catch up, but nobody else wants to go unless everyone's already there. So I feel like this is a good solution, that having a DEX where, you can just like have that, that last stop where, it's all together, except for if you want to all of a sudden trade securities at that final touch point, then you can do a KYC. And I feel like the KYC is getting easier as well with the soul-bound tokens, with just the decentralized nature of it, sort of, and the ZK part of it, also ensuring your privacy. Is that how it's being built out right now on Pegasus?
Right. And so you're just saying you don't need a STO, security token exchange, or offering exchange. Anyone can plug that EAS check in on the last route. And if it's done, then you're opening that up to anyone. So it could be it could be like a game that accepts these tokens. And if it happens to be that there's a transfer in the game between people, just adds that EAS check that the end user has been KYC. Now you're able to do security token trades in game. It opens it up so that you have DeFi integrations that will plug these in really easily and quickly. And, we can monetize the fact that there's a DAO. We are the ones that are attesting the resolver in this case. But in the future, if we go away, the DAO can just say, no, we want someone else to resolve the KYC on this. And so the beauty of the Web3 spec of the DID is that anyone can do that resolving. We just happen to be the first. And we're monetizing that as a company, saying, we'll take profit from each resolution. But if the DAO thinks that there's someone better fit for that, maybe taking less fee or giving better value, then we will kind of move along. And so we've kind of taken that product and give it to the market. But at the same time, this is all on Rolux. So it's helping Syscoin, it's helping Rolux, helping the infrastructure. So the main value is always going to be the blockchain. And the monetization is just an aspect of bringing users on that blockchain. So we would minimize the profit side to a point where we're making money, but it's minimized to try to bring in the users to the blockchain.
Very interesting.
Real world assets, and that's really interesting. I think it's a unique take on all of this because we start with there's no way we're going to let centralized permission assets be the ruling here. So how can we do it without that? And if you go down that chain of thought, then you end up at this sort of solution where you're breaking up secondary trading and primary issuance.
And I feel like real world assets is a category of blockchain that it has a lot of promise and is still very early on. It's just trying to get down the mechanism for at least this, having the security tokens. Where can you issue them and trade them easily? But I feel like beyond that, there's almost everything in the world that's a real world asset can be tokenized and traded. It's just a matter of figuring it out in a way that makes it easy to onboard and do it. But obviously the benefits are there over the traditional trading system of the costs and the time and things like that. Where do you see this expanding to beyond just what we're talking about as this first example?
Well, because they're just standard ERC20s, any protocol can plug them in, right? And especially with any of the other DeFi protocols, they could just plug them in. It's really up to the user to decide, okay, there's some random protocol that's doing sales, but because you're in the books, you're a grown person. If you make that decision to do that, then it's on you. But that protocol, say one of the protocols has the KYC check, and now you plugged in a game or you plugged in some other DeFi protocol, it's really easy to make it interoperable with almost everything because it's just a standard ERC20. There is no gatekeeping in the token or the whitelist, blacklist that might affect a DeFi suite from accepting it or rejecting it because it just can't. But it allows you to really go global within that DeFi ecosystem, and it's up to the onus should be on the person holding. They're in the books, right? Because if they've been part of the issuance platform, they've been checked, and so there's a source of check happening on the primary issuance. If they go into Pegasus, they're fine. The new person in Pegasus has been checked. There's a lineage of KYC there. If you break that chain at any time, the issuer can call upon you and be like, why did you do that? That's not registered action. So we can, at that point, they can do something about that. There's penalties or whatnot. Or you may not be able to, as a new buyer, you may not actually own that token, the actual asset behind it. If it's a real estate deal, you may not actually fractionally own that real estate to get dividends because you didn't get that in a safe way. You got that random DeFi protocol that didn't do the KYC check, and we don't know who you are. So you can go off and go to the issuer and be like, this is me, and we did this proper sale, and like, okay, everything's fine. Go, it's fine, but it's up to really the owner. Instead of enforcing a check to happen every transfer or enforcing a blacklist and whitelist, we instead say, at the end of the day, it's you making that decision in the same way that you report your taxes to the government today.
And speaking of the sort of more decentralized nature of it, I know that Syscoin was working on a DAO Sys, and I feel like there's a lot of promise for governance in DAOs. Can you talk about the DAO Sys and how exactly that DAO works and how it adds benefits to things like this?
Yeah. The institutions, and people, they want other opportunities to take their positions and make money off it, like almost like when the concept of ETF was created in the stock market. It kind of made the stock market blow up, and the recent incarnation of the stock market is due to IPOs, but also ETFs. In the .com boom, there was IPOs that came, and there was a new way to raise funds. And ETFs is sort of the registered class of people that are just parking money and, hopefully beating inflation. People create packages that will appeal to different sorts of investors and say, almost like bonds, like this one will earn 5%, this one is more risky, this one's less risky, this has gold in it, this has this in there. So ETFs are a way, it's sort of this new class, decentralized ETF, new class. So we call that sort of liquidity tree. The key thing with Dysis that we're bringing in is we've figured out a way to do, to solve for or mitigate impermanent loss. That's a big thing. Anyone in DeFi knows impermanent loss is a bad thing. And it happens in Web2 world all the time. And we call that mark to market. When you're in a trade and it's $1 billion, hedge fund trade that's trying to sell, they're going to get huge impermanent loss if the market is illiquid, especially what we saw with in 2007, 2008, where you had impermanent loss basically took down the whole system because there was not enough liquidity to buy that fractional debt that was being created and sold and packaged. And then there was real people going bankrupt with the real homes that repackaged debt just couldn't, it wasn't worth anything, but there was no market for it. And so we used cascading effect. And the mark to market was to hope to solve that problem where your position is being marked in the market. So if you sell, it's for this price. It's not the market price, it's below. And based on that, your profitability or whatever is all reflected. But if you can mitigate impermanent loss with smart contracts or with clever game theory plus smart contracts, then now you got a whole new class of investment concepts that never were possible before. For example, like if you're holding ETH in USD LP position on Uniswap today, you're bullish on, say, crypto with ETH, but you're also kind of half and half with USD in case ETH goes down, you're earning more. But if ETH goes up, you're still benefiting, right? Mm-hmm. The problem is you're only earning 3 to 4 or 5%. You're not beating inflation today. So that's what's drawing capital out of the market today is I'd rather just hold US dollars. I'm earning 7 to 8%. Why would I need to? I'll wait for crypto to bottom out, or I'm earning more anyway. So, if I hold $1 billion here, I'm probably benefit more just holding US dollars at this moment than speculating on crypto, which may go down. So in order for you to beat inflation, you would need to solve for impermanent loss, because you'd take that existing LP position, you'd put it elsewhere and earn more, another 3 to 4%. So we know crypto has this huge upside story, and it's long-term is beneficial for many reasons. IoT, smart cities, AI, it's all leaning towards crypto, but people need to think what's going to be short-term valuable to them with that large sum of money. If you're not beating inflation, then you're taking a loss. I need somehow to invest in something or keep it in dollars. Dollars are king right now to beat inflation. If you could take that position, put it elsewhere and make money, and that's where this decentralized ETF concept comes into play with liquidity tree. So you can take your ETFs, create ETFs and arbitrage through this tree-like structure where people are bringing in LP positions, and it's adjusting the balance of the tree. Someone's able to take a position against you. They're closing their arb. The liquidity creates incentives. That incentive creates volume. And then all of that, you're mitigating impermanent loss. If you're to sell, you're going to sell at a certain rate, almost marking to market. It's a mark-to-market strategy for DeFi, basically. And if you're able to mitigate that permanent loss, now you're able to safely earn another 3 to 4% on top of that with the volume coming in through that concept. Dysis is sort of a layer on top of that. It's our vaulting mechanism to figure out, without voting-based DAOs, because humans are involved in voting, and we know that's not going to fly long-term. You vote with the fraction of money you earn. All you get to do is take in money, exit money. And when you exit money, you're just taking that capital back out, or you take in money and tell it where to put it in liquidity tree. So which ETF or basket do you want to put your money in? And then you get into Dysis, right? Dysis is sort of like a vault that was akin to when Olympus DAO came out, right? Everyone knows Olympus DAO is $5-10 billion TVL at peak. The initial creator of Olympus DAO that created the code, his hopes were to create a monetary mass that could come out of that to create store of value and currency coming out of it. The problem was Zeus took the code and he added this Ponzi tokenomics with high interest rate on top, and it created a viral growth pattern that ended up in tears, which was designed to do. And then the early team might have sold or whatnot. Large whales were dumping. It created a cascading effect that didn't end up well. So the initial concept of Olympus DAO is to hold protocol liquidity, and the money is being earned in the treasury, recouping one-to-one collateral, and it's growing over time. Sort of like a monetary mass. That's where it comes from, right? Mm-hmm. As more mass comes, the more profits are generated, the more liquid everyone becomes, the more profit the protocol is, the token goes up and associated, not some crazy high inflation. So the concept starts there, where you have protocol owned liquidity, and you make it one-to-one backed. You don't have any Ponzi tokenomics on top. Mm-hmm. There needs to be real profit being derived for the market cap to go up. So liquidity tree is sort of this decentralized ETF that feeds part of its fees back into Dysis. So when you come into Dysis with, say, ETH USD, you take the LP positions earning 3-4%. You give us that 3-4% into Dysis, you get the Dysis token, but we don't hold that LP position. We take that and we throw that into liquidity tree. So that's earning now 6 to 7%, right, safely. And that 6 to 7% is being fed back into Dysis market cap. You own Dysis, which is the token, and that is marked based on the market cap. So if the market cap grows and crypto is booming, that Dysis token should benefit, because you can extract that capital back out. In order for you to extract the capital back out, you have to burn that Dysis token. So the only way for the Dysis token to come into existence is for you to provide liquidity akin to how much the market rate is. And the only way for you to extract it is for you to burn that token. So the price should stay consistent when a large whale sells, because the supply goes down. And that's the interesting thing, is the monetary mass starts to be created. And then from there, you have that real sort of Olympus DAO story that was meant to be. In order for you to create currency out of that to transact, you could turn around and take that Dysis token, which, by the way, is backed by all these layer 1 gas tokens. Through ZK proofs, we bring in the gas tokens from ETH, from Avalanche, from all the real good layer 1 decentralized gas tokens. Dysis accepts those as positions, and through ZK proofs, through multi-chain we bring that in, working with the Polyhedra group there for ZK proofs. We now have a Dysis token that's backed by all the other layer 1's gas tokens. So it's fully decentralized. You take that and you put it into something like RAI, which is the algo stable, right? Now you have currency. So if I want to pay a developer right now, everything's based on US dollars, so $1,000 of value, and I want to know that in 1 year, the $1,000 of value is still there, right? You would have an algo stable for that. You'd peg it to $1,000 of value. So Dysis and to RAI is almost like ETH to RAI on Ethereum, but with ETH, you're not backed by all of the layer 1 gas tokens, so there's no distribution of risk. It's ETH or go home, right? In this case, it's all of them put into one group, backing a algo stable, which in itself is earning profits based on this ETF system that's creating impermanent loss mitigation for people to hold their assets long term, creating viral loops back into a profitable sort of treasury that creates an upside story for this token, which itself is fed into RAI. That's an algo stable. So now you have store value, and then you have medium of exchange and unit of account through the algo stable. So that's
very cool.
Dysis.
And what is the best way to get, once you get an understanding of it, to get started, get involved with Dysis? How would you take the first steps to do that?
So we would have sort of like a layer 0 or a ZK-like client that we build on our chain from all the other chains. And you would just take your existing LP position that you have on ETH. And I don't think anyone has built, there's been no reason for people to take LP positions and move them across chains, right? Right now, the bridges ask, oh, please unstake your ETH, unstake your LP, give me the ETH or give me the USD, which kind of defeats the purpose, because I want to keep that position, right? I want to keep my stake in there. I don't want to remove that. I'm earning ROI on that. I don't want to touch that. We will take the LP position and come across chains, right? And so there's a rebasing and stuff. So we have to handle the messaging for that. And we do that through the ZK Lite clients. So you would just, in our DApp, you would just say, here's my ETH LP position, accept it. And we'd click a button, approve, and it would put it into the DAO. You own the receipt for that, which would be the Dysis token. And you can come back at any time. You can either sell that Dysis token, or you can go back to the treasury and take your position back out. And so based on how much value you have, you take that position back out. So it's a pure value add to all of the DEXs and all of the chains, basically, because that system will accept the main gas tokens of all of the chains, right? And the liquidity tree will accept everything. I mean, you can create pairs of anything, ETFs of anything. But Dysis itself will just take the core valued assets like the ETH, Avalanche, these ones are paired against some decentralized form. So it's fully decentralized and not susceptible to centralized risk. So it may not even take USD, for example. It may only just take ETH to wrap Bitcoin, or ETH to Avalanche, or just layer 1 gas tokens to be fully decentralized.
Amazing. Well, I'm definitely going to dive into it myself as well. I can leave the link to Dysis and the other use cases that we talked about with Super App, Pegasus, any other links that you want. I can put it into the show notes for the viewers. I don't have any time left, but we covered a lot in this section, as we always do. Jag, I know you are constantly working on improving the blockchain industry. Get ahead before AI takes over. So I really do appreciate you taking the time today. And let's definitely follow up in the near future with more of the latest updates from the Syscoin ecosystem.
Yeah, we didn't touch on Super DAO or Super DApp, which was the AI SocialFi, but we can do that on a subsequent one, and maybe we can show that live or demo that instead of just talking about it, because it's getting to a point where it's going to be people will be able to use it pretty soon.
Awesome. Coming to viewers in the near future. Amazing, Jag. Thank you so much. Appreciate it, and all the best moving forward.
Yep, you as well. Thanks for having us again.